Welcome to vTalkInsight, Allocator's Lens Daily for February 4th, 2026. Cross-asset markets are juggling strong earnings, stickier inflation risks, and rising policy uncertainty, with AI and geopolitics cutting across every asset class. Equity indices are still close to highs, yields are edging up again, credit spreads remain tight, and gold is back in focus as data delays cloud the macro picture. Let us unpack how that backdrop is reshaping risks and opportunities across portfolios today. In equities, the core tension is that top-down conditions still look constructive while bottom-up dispersion and valuation risk are rising, especially around AI. Major indices remain near records, but the latest session saw the S&P 500 down close to 1% and the volatility index push up toward 18 as stronger U.S. manufacturing data chipped away at hopes for rapid Federal Reserve cuts. Earnings support remains solid. S&P 500 companies are again beating expectations, reinforcing a double-digit profit growth path. European benchmarks are also printing fresh highs with industrials, basic resources, and technology leading the way. Above potential U.S. growth, helped by resilient consumption and AI-driven capital spending, continues to underpin risk sentiment in global equities. Beneath the surface, leadership is rotating. Hardware and memory suppliers tied to the AI build-out continue to enjoy strong demand and pricing power, while software and SaaS names have fallen sharply from their peaks, with one widely watched index now more than a quarter below its high. Stock-specific reactions around Microsoft, Meta, and AMD show how small changes in AI guidance can move prices dramatically. Palantir's very strong growth, but demanding revenue multiple is a clear example of the market rewarding delivery, yet questioning how far valuations can stretch. At the same time, other segments are gaining share. Mid-cap U.S. companies with better earnings and lower leverage are being highlighted. Cyclicals such as industrials, energy, and materials are supported by stronger data and higher commodity prices, and European financials and asset managers are participating as capital rotates away from pure dollar assets. Within healthcare, GLP-1 drugs are creating clear winners and losers, while in media, Disney's profitable streaming and park-driven growth is rebuilding confidence. For allocators, equity risk feels more about where AI exposure, earnings durability, and balance sheet strength overlap than about simple index direction. The broadening beyond a handful of mega-cap AI names is encouraging, but it puts more weight on stock, sector, and regional decisions as markets digest upcoming earnings alongside a noisier macro and political backdrop. In rates, investors are dealing with firmer activity data, uneven inflation signals, and shifting expectations for central banks. In the United States, stronger manufacturing readings have lifted short maturity yields and nudged the expected start of Fed easing toward mid-year, reversing some of the aggressive cut pricing seen earlier. Uncertainty around potential leadership changes at the Fed and talk of outcomes ranging from faster cuts to even yield curve control adds another layer of volatility to term premia. Policy divergence is emerging. The Reserve Bank of Australia has become the first major central bank to raise rates this year, citing persistent above-target inflation and resilient housing and labor markets. The move pushed Australian yields and the currency higher, but cautious guidance showed limited appetite for a full renewed tightening cycle. That contrast with a more patient Fed and disinflation in parts of Europe highlights the complexity of reading the global rate path. At the same time, heavy issuance and strong demand coexist. Global bond sales have already topped $1 trillion this year as governments and companies fund deficits and capital expenditure, including AI infrastructure. Yet recent U.S. Treasury auctions have been several times oversubscribed. Many investors expect a gradual steepening of the yield curve, helped by that supply and by perceptions that front-end policy will ultimately turn more supportive. Disinflation in places like France and selective price cuts from multinationals point to easing pressure in some areas, but supply chain rewiring and higher energy costs remain a counterweight. with key U.S. data releases delayed by the shutdown and measurement issues clouding labor statistics. Rate markets are likely to trade data point by data point once the calendar normalizes. In credit, conditions look benign on the surface, but increasingly late cycle underneath. Spreads are at their tightest since the late 1990s, supported by solid growth, low default expectations, and strong demand for income. And ongoing central bank accommodation is still seen as an anchor. Issuance, however, is heavy and revealing. Large investment-grade deals, such as Oracle's recent $25 billion sale, are oversubscribed and tighten in the secondary market. But the urgency with which borrowers are locking in funding speaks to awareness that windows can close. Credit investors are also watching the growing weight of hyperscale tech and AI-related issuers in benchmark indices, particularly as several firms, including parts of big tech and infrastructure providers, are increasingly funding massive AI capital expenditure with debt rather than free cash flow. Beyond public markets, NAV financing and asset value lending are expanding quickly as private equity managers use them to support existing portfolios and new deals. Data suggests this could become a several $100 billion segment, effectively adding leverage on top of already financed assets. For allocators, that mix of very tight spreads, rising exposure to AI-linked leverage, and softer household metrics, such as higher credit card balances and flat real incomes, means credit is still supported but more vulnerable to a growth or policy surprise. Differentiating between borrowers with self-funded investment plans and those relying on markets, and between more and less liquid parts of the capital structure, remains a key theme as the cycle matures. In foreign exchange, the interplay between policy divergence and a structurally softer dollar narrative is increasingly important for multi-asset positioning. Expectations that future U.S. policy will be more tolerant of a weaker dollar, together with reserve diversification and private flows, are encouraging investors to look beyond U.S. assets while often retaining U.S. equity exposure. One clear sign is the surge in demand for FX-hedged U.S. equity positions. Over the past year, the share of new flows going into hedged rather than unhedged structures has risen from low single digits to well over 1/3, indicating that currency risk is being separated from equity risk more explicitly. Policy moves abroad are also driving dispersion. The Reserve Bank of Australia's rate hike has supported the Aussie dollar, while the new U.S.-India trade deal, with sharp tariff cuts and a potential reorientation of energy imports, has boosted Indian equities and the rupee. Strong inflows into emerging market debt, in both local and hard currency, reflect appetite for higher real yields and a constructive growth backdrop. Digital assets stand in contrast. Bitcoin has dropped more than 7%, to the lowest level since late 2024, and failed to benefit from recent dollar weakness or gold strength. The narrative of Bitcoin as a straightforward inflation or dollar hedge is fading, just as institutional attention shifts towards stablecoins and blockchain rails. For allocators, that reinforces the view of crypto as a distinct, high-beta risk asset class rather than a simple macro hedge. In commodities, markets are balancing safe haven demand, growth optimism, and geopolitics. Precious metals have snapped back after the sharp corrections highlighted last week. Gold has surged around 4 to 5% and is approaching the $5,000 mark, while silver is up roughly 10%. The rally reflects renewed interest in real assets as alternatives to the dollar and equities, alongside elevated volatility as flows move from deep markets like treasuries into smaller metal complexes. Gold retains strong structural backing from central bank diversification and its low correlation with stocks and bonds, but the recent swings show that returns are unlikely to be linear. Silver's tendency to move 2 to 2.5 times as much as gold in both directions, combined with the fact that most supply is a byproduct of base metal mining, reinforces its role as a high beta expression of metal sentiment rather than a pure safe haven. Notably, gold's recovery versus a weaker Bitcoin underlines its current dominance as a portfolio hedge. Industrial and energy commodities are tied more directly to growth and policy. Copper is up about 4% on reports of Chinese inventory building, lifting mining and basic resources shares and underscoring expectations for ongoing demand from electrification and AI-related data center buildouts. U.S. and allied investment in rare earths and critical minerals, including a planned $12 billion strategic stockpile and new North American projects, is rewiring supply chains under a security lens. Oil prices are being supported by geopolitical incidents involving key producers and by changing trade patterns, while rising electricity demand is driving renewed interest and deal activity in renewables and power infrastructure. Together, these trends keep commodities central to the inflation debate and to regional growth dispersion. Stepping back, the cross-asset picture shows a market that is still broadly constructive but more finely balanced. Equities are supported by strong earnings and AI-driven growth. Yet leadership is rotating and valuations in the most crowded trades are being questioned. Rates are repricing to firmer data and policy uncertainty, with front ends grinding higher even as many expect eventual easing and a steeper curve. Credit remains tight and well bid, but leverage in AI and private structures is creeping up, leaving spreads more exposed if growth or policy disappoint. In FX, expectations for a softer dollar and diverging central bank paths are encouraging geographic and currency diversification, while crypto behaves more like a speculative asset than a hedge. Commodities from gold to copper and oil both reflect and influence those narratives, linking geopolitics, inflation, and growth. For allocators, the focus over the coming weeks is likely to stay on how AI capital expenditure translates into actual cash flows, how delayed and revised macro data reshape the growth and inflation story, and how geopolitical and policy headlines affect energy and trade. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.